Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
What if I told you that one of the oldest and honestly most systemically important banks in the UK just let artificial intelligence write 40% of its foundational code?
I mean, it sounds like science fiction, right?
Exactly. Welcome to today's deep dive. We are, looking way past the traditional marble columns and vault doors of finance today. We're staring straight into the algorithms, the balance sheets, and the macroeconomic crosswinds of NatWest Group, or NWG.
Right. And our mission for you today is to really dissect the mechanics here. We want to look at the strategic maneuvering and, frankly, the underlying health of this absolute behemoth of a bank.
Yeah, and to do that, we are pulling from two really incredible sources. First, we have this highly detailed research report from Compasscope, which is dated June 1st, 2026.
And to pair with that sort of theoretical analysis, we have the raw reality of NatWest's official Q1 2026 earnings call transcript. That one is from May 1st, 2026.
So if you're someone who's, fascinated by how traditional legacy finance is quietly colliding with cutting-edge tech behind closed doors, this deep dive is your ultimate shortcut to getting fully briefed.
Definitely. The goal here is clarity. I mean, we want to take these incredibly dense financial documents, like the risk models and the forward guidance, and map out exactly how this institution generates yield.
Right, and conversely, where its structural vulnerabilities actually lie. So, okay, let's unpack this. To understand where NatWest is going, we kind of first have to map out exactly what it is.
Yeah, that's a crucial starting point. Translating the sheer scale of a modern bank into something digestible, well, it requires cutting through a lot of executive jargon.
Totally. I like to think of NatWest not just as a traditional bank, but really as a massive financial utility grid for the entire UK economy. And this grid basically has four main power lines running through it.
I like that utility grid analogy. So you've got retail banking, commercial and institutional, which they usually just call C&I, private banking and wealth management, and then those central group functions.
Exactly. And we need to understand how those lines interact, right?
Yeah.
Like, let's look at that first power line, the retail side. It's not just people walking into branches anymore.
No, not at all. It's prime residential mortgages, instant access savings, and crucially, these white label partnerships.
Yeah.
Like they have this proposition called Boxed.
Oh, right. Boxed.
Yeah, where they essentially provide the underlying plumbing for savings products offered by brands like the AA, Saga, and Sainsbury's. So they are, capturing retail deposits even when their name isn't actually on the front door.
Which is so vital because those deposits basically fuel the rest of the grid. But then, you look at the second power line, the commercial and institutional side, and the scale there is just completely different.
Oh, completely. We are talking about highly complex project finance, national infrastructure, and this massive push into the startup space.
Yeah, the sources noted that in the first quarter of 2026 alone, NatWest onboarded 24,000 new UK startups. I mean, that is a 25% increase year over year.
Which is staggering. The duality of that business model is just really striking. On one hand, you have the retail arm playing a massive volume game.
Right, like prime UK mortgages on very tight margins.
Exactly, with highly predictable consumer behavior. But then you have the C&I arm taking that capital and deploying it into higher yielding, much more bespoke areas. Things like renewables, social housing, and those tens of thousands of early stage tech companies.
I do have to push back on that setup, though. With such a massive retail footprint, I mean, millions of everyday consumers, how does a single executive team balance that?
Balance the different risk appetites, you mean?
Yeah, like how do they balance the needs of the average checking account holder with this incredibly aggressive push into corporate project finance and high-growth startups? Because those two worlds require completely opposite risk frameworks.
That tension is literally the defining challenge of running a universal bank.
Yeah.
And the mechanism they use to handle it is structural isolation, which brings us to your fourth power line.
The central group functions.
Right. Think of them as the massive transformers on that utility grid. Their entire job is to manage the capital and the liquidity flowing between these very different divisions.
So they basically ensure that a massive surge in risk on the commercial side doesn't blow up the rest of the bank.
Exactly. Say a huge wind farm project goes bankrupt. The central functions ensure that failure doesn't blow out the transformers and threaten the stability of everyday retail deposits. They don't mix the underwriting at all. They just manage the firewalls between them.
Okay, so if NatWest relies on this highly managed, isolated utility grid, How does it stack up against the other major grids out there? Because the Compasscope report breaks down the UK Big Four, and the contrasts are pretty sharp.
They really are. Take Barclays, for example. Their structural model relies really heavily on global investment banking and this massive U.S. credit card business.
Which I imagine provides incredible upside when global markets are booming.
It does, but it also introduces tremendous, completely unpredictable volatility. And then you have HSBC, which is deeply intertwined with growth in Asia. That brings a completely different set of geopolitical risks into their earnings.
Right, whereas NatWest is almost stubbornly domestic by comparison.
Yeah, which is a very deliberate strategic choice. Honestly, the closest comparison is Lloyd's.
Because they're both highly concentrated in the UK.
Yes, but even there, their risk appetites diverge pretty significantly. Lloyd's leans quite heavily into unsecured consumer finance, so think motor finance and personal loans.
Got it. While NatWest bets on that commercial and institutional sector we were just talking about, corporate infrastructure rather than consumer credit cards.
Exactly.
Well, we really can't talk about competitors without bringing up the digital challengers and the fintechs, right? I mean, the Monzos and Starlings of the world, they've built these beautiful, seamless user experiences.
Oh, absolutely. The user interface on those apps is incredible.
Yeah, and everyone is always talking about fintechs eating the lunch of traditional legacy banks because they have that agility.
The fintechs have definitely won the battle for user interface. There's really no debate there. But NatWest holds two profound structural trump cards that a beautiful app simply cannot replicate.
Okay, I'm listening. What's the first one?
The first is incredibly cheap, highly sticky funding. NatWest has a £172 billion structural hedge.
Wait, let's actually define how that structural hedge functions day to day. Because it sounds like abstract high finance, but the report makes it clear it's the core of their profitability.
It really is the absolute engine of the bank. So because NatWest holds millions of everyday checking accounts, current accounts that pay the customer basically zero interest, they have access to billions in essentially free money.
All right, my checking account definitely isn't paying me anything.
Exactly. So the bank takes that incredibly stable pool of free money and goes out and buys 3-year or 5-year government bonds that are yielding 4 or 5%.
Wow. So they are locking in billions in pure risk-free profit simply because you leave your paycheck sitting in your account.
Precisely. A startup bank that has to pay really high interest rates just to acquire brand new customers, they simply cannot generate that kind of passive guaranteed income.
That makes a lot of sense. And what's the second structural advantage they have over the fintechs? The Compasscope report mentions something called IRB models.
Yeah, so IRB stands for Internal Ratings-Based Models. Because NatWest has decades and decades of historical data on exactly how millions of loans perform through recessions, boons, and crises, regulators actually allow them to use their own proprietary models.
Oh, to calculate how much capital they need to hold in reserve against their loans.
Exactly. A newer challenger bank just lacks that decades-long history. So the regulators essentially force those startups to use a standardized, much stricter model.
Meaning the startup has to hold significantly more cash in the vault for the exact same type of loan, while NatWest can lend much more efficiently purely because of their legacy data.
That's it exactly. It's a massive, massive moat.
But moats really just protect you, you know? How does a legacy bank actually grow? Because just treading water isn't enough for the markets.
No, it's not. The Compasscope report actually outlines a highly disciplined growth target for them. They are aiming to grow customer assets and liabilities, or CAL, by more than 4% annually.
Okay, and how do they actually hit that 4%?
A major mechanism for achieving this is their huge pivot into wealth management, specifically through the acquisition of a firm called Evelyn Partners.
Right. The logic there is essentially cross-selling. They want to identify affluent retail customers who are already at NatWest and migrate them into Evelyn's bespoke advisory services.
Yes, and they are targeting £100 million in recurring cost synergies from this merger alone. Wealth management is just highly attractive to them.
Because it's fee-based.
Exactly. It generates steady, reliable fee income without requiring the bank to put huge amounts of its own capital at risk.
Here's where it gets really interesting, though. When we think of a bank growing, we usually picture them like acquiring wealth managers or opening physical branches.
Right, the traditional expansion playbook.
Yeah, but the Q1 earnings call transcript revealed that staggering technology statistic I hinted at during the intro. NatWest employs over 12,000 software engineers.
It's an incredible number.
And the CEO, Paul Thwaite, literally noted that over 40% of their code is now written by artificial intelligence.
Which fundamentally alters their entire operational efficiency. It goes way beyond just writing code faster.
Yeah, they specifically highlighted this concept of agentic software development. They gave this crazy example of building a new customer proposition.
Oh, right. Historically, that specific task took 12 human engineers a full 6 weeks to build.
Exactly. And today, using autonomous AI agents, they can complete it with just 3 human engineers and 7 AI agents in 6 hours.
It's unbelievable. Moving from 6 weeks and a dozen people to 6 hours and 3 people,
Yeah.
that completely rewires their entire cost-to-income calculus.
It's a totally different company at that point. But alongside the AI, there is another massive structural growth pillar that both sources highlighted: climate finance.
Yes, this is huge. NatWest is targeting £200 billion in climate and transition finance by 2030. And they've actually already delivered $29 billion just since last July.
And for you listening, I think it is really crucial to understand that this isn't just a feel-good ESG initiative designed for a glossy annual report.
Oh, far from it. This is a purely capitalistic, highly profitable growth strategy. I mean, the entire global economy is transitioning to green energy, and that transition requires just unprecedented amounts of capital.
We are talking about complex project finance for offshore wind farms, retrofitting social housing at scale, and radically upgrading the national electrical grid.
Exactly. NatWest is essentially maneuvering its commercial and institutional power line to be the primary financier of that green transition in the UK.
Because it offers strong risk-adjusted returns while aligning perfectly with all these incoming regulatory mandates.
Precisely.
Let me pause you there, though, because moving a software development cycle from 6 weeks to 6 hours using AI agents sounds revolutionary, sure, but it naturally begs the question, what is the catch?
There's always a catch.
Right. If you are moving that fast and letting autonomous AI write nearly half the code for a systemically important national bank, doesn't that open the door to catastrophic cyber vulnerabilities or operational model risks?
It's a very valid concern.
I mean, a single bad line of code in a major banking app literally freezes millions of people's livelihoods overnight.
Well, if we connect this to the bigger picture, you are hitting on the exact execution risks that the CompuScope report flags. Well, NatWest's overall execution risk is generally lower than its global peers.
Because they aren't trying to navigate, Asian geopolitics or Wall Street volatility.
Right. But they do have incredibly concentrated specific risks. The operational risk of rolling out AI at that kind of scale requires intense, almost flawless governance and cyber resilience.
That makes sense. Beyond the aggressive AI rollout, though, what else threatens their growth targets?
Well, because they are so thoroughly domestic, they are hyperexposed to the UK macroeconomic climate. If the UK housing market severely corrects, for example, NatWest feels that impact instantly.
Yeah, there's no international buffer to soften the blow.
Exactly. Furthermore, that Evelyn Partners acquisition we talked about introduces massive integration risk.
Oh, absolutely. Mergers always look perfect on a sleek Excel spreadsheet, but the reality of actually integrating 2 massive companies is usually incredibly messy.
It is notoriously difficult. You're integrating legacy IT systems between a massive retail bank and a boutique wealth management firm. That alone is a nightmare.
Not to mention the cultural clashes, right? Like, retail bankers and private wealth advisors operate in completely different universes.
Spot on. If they miss that £100 million cost synergy target, or if Evelyn's wealthy clients feel the customer service is degrading and pull their money out, that entire growth pillar just crumbles.
Wow, so the stakes there are high. Are there other structural risks?
Yeah, they finally face severe duration risk on that £172 billion structural hedge. If their internal models somehow miscalculate how long customers will actually leave their money sitting in those zero-interest accounts, their entire multi-year margin projection will just collapse.
You mentioned the risk of their macroeconomic models being wrong. Let's actually look at what happened when they had to apply those models to reality in their Q1 earnings call.
Right, the Q1 update. So the headline numbers presented by their CFO, Katie Murray, were undeniably robust. Customer lending actually grew 6.6% year over year to £400 billion.
And customer deposits increased by 2.6% to £445 billion. Those are solid numbers.
They are. And then there's the metric that bank investors absolutely obsess over, which is return on tangible equity, or RoTE. It hit a phenomenal 18.2% in Q1.
And for you listening, RoTE is essentially the ultimate scorecard for a bank. It basically measures how much pure profit they're generating from the actual physical cash that shareholders have invested in the business.
Yeah, and hitting 18.2% is just massive for a traditional bank. Because of this momentum, management actually upgraded their full-year income guidance to the very top end of their range, expecting up to £17.6 billion.
But the data actually complicates that rosy narrative a bit when you look closely at the accounting. Despite those fantastic growth and return numbers, NatWest still took a £140 million impairment charge.
Yes, they did.
Wait, I was looking at these Q1 numbers, and there's a glaring contradiction here to me. An impairment charge implies that loans are going bad. But management explicitly stated that their arrears, people actually falling behind on their payments, are currently below the sector average.
Right, arrears are very low.
So if no one is actually defaulting right now, how do they justify taking a £140 million loss on the books?
It all comes down to a really specific accounting mechanism called ECL, or expected credit loss modeling. Under the ECL rules, a bank cannot just wait for loans to actually default. They have to proactively provision for losses based on future macroeconomic forecasts.
Oh, okay. So it's about what might happen.
Exactly.
Yeah.
NatWest's economics team recently revised their view of the UK economy. They now expect interest rates to stay, quote, higher for longer, remaining at 3.75% for the rest of 2026.
Right, and they also forecasted inflation peaking a bit higher at 3.5%, which leads to anemic GDP growth of just 0.4% and unemployment ticking up to 5.7%.
So the ECL models essentially say, mathematically, based on these worsening variables, a certain percentage of people will likely default in the future. The bank has to take the financial hit for that future probability today.
So it is essentially a proactive buffer, not actual cash lost out the door this quarter.
That's exactly right.
Now, speaking of all these shifting variables, I noticed a bizarre, highly specific consumer behavior trend in the Q1 mortgage market data.
Oh, fixed rate shifts.
Yeah. The classic 5-year fixed mortgage, which has been an absolute staple of the UK housing market for decades, is suddenly being totally abandoned.
It really is. Historically, the 5-year fix made up roughly 66% of their fixed mortgage book.
But the recent Q1 data shows that 77% of all new mortgage originations are suddenly 2-year fixed deals. That is a massive swing.
It's a huge swing. Consumers are basically looking at the current rate volatility and essentially betting that rates will drop significantly in the next 24 months. They are flat out refusing to lock in today's higher rates for a full 5 years.
It is a perfect illustration of how big macroeconomic uncertainty directly alters, kitchen table financial decisions.
Absolutely.
There was another fascinating mortgage detail in the earnings call. Typically, a bank writes new mortgages, the front book, at much lower profit margins than their older existing mortgages on the back book.
Right, because competition for new business is just incredibly fierce.
Exactly. But Katie Murray noted that in April, their new mortgage margins actually jumped above their older ones. How is that even possible when everyone is fighting tooth and nail for new business?
It comes down to their technology and swap rate volatility.
Yeah.
So swap rates are the underlying wholesale interest rates that banks use to actually price their fixed mortgages. When those swap rates change rapidly, banks have to quickly reprice their consumer mortgage products.
Which takes time if your systems are slow.
Precisely. Because NatWest invested so heavily in digitizing their entire mortgage platform, they could react incredibly fast. They actually repriced their mortgage products 11 times in just 22 days.
11 times in less than a month.
Yeah. Meanwhile, slower competitors were stuck offering outdated, lower margin rates while their IT systems tried to catch up. That tech agility allowed NatWest to capture much higher margins in real time.
That is wild. So, synthesizing everything we've covered, from the Q1 reality check to the Compasscope structural analysis, what does this all mean for you, the listener, tracking this space over the next year or two? What are the critical indicators to actually watch?
Well, first and foremost is the shape of the UK yield curve and the actual path of the Bank of England's base rate. That directly dictates the profitability of that massive £172 billion structural hedge we discussed earlier.
Right. If rates drop significantly faster than their higher for longer assumption, the income generated from that free current account money shrinks drastically, doesn't it?
Exactly. And if that happens, their very bullish revenue guidance will be under severe pressure.
The second major factor, I'd say, is monitoring the retail payment shock. There are still big cohorts of consumers sitting on historically low COVID-era fixed-rate mortgages that just haven't expired yet.
That's a ticking clock.
Yeah.
When those finally do expire, those households will instantly jump to new 4% plus rates. How the consumer absorbs that shock, whether it triggers actual defaults or just totally crushes consumer spending, will directly dictate NatWest's real-world impairment charges going forward.
And that kind of leads into the wholesale risk side. The analyst Q&A during the earnings call highlighted a very niche area of their commercial and institutional book that really caught my eye. Funds lending.
Ah, yes, the subscription lines.
Right. The disclosures show that NatWest has nearly 17 billion pounds wrapped up in these subscription lines. And for those unfamiliar, subscription lines or capital call facilities are short-term loans, usually 1 to 3 years, made directly to institutional funds like private equity firms.
Right, so the fund borrows money from NatWest to make a quick investment before they actually bother collecting the pledged cash from the wealthy investors.
Exactly. Now, NatWest is lending at incredibly conservative loan-to-value ratios here, typically around 30%, and they proudly stated on the call that they have 0 historical losses in this specific business line.
Which is great, but 17 billion pounds is a massive chunk of capital to have tied entirely to the behavior and liquidity of private financial markets.
Exactly, and this is why it matters to you. If private equity markets freeze up, or if institutional investors suddenly delay those capital calls, that pristine zero-loss history is going to crack.
And if NatWest suddenly has to absorb unexpected losses in wholesale funding, they will immediately tighten their lending across the board.
Right. That domino effect means they pull back from funding those 24,000 UK startups and green infrastructure projects we discussed earlier. It is a critical metric of institutional risk.
I agree completely. It will be the ultimate stress test of their underwriting discipline in an evolving macroeconomic climate.
Well, we have covered a tremendous amount of ground today. We really stripped away the jargon to look directly at the engine underneath NatWest Group.
We mapped out their utility grid, explored the incredible multi-billion pound moat provided by their structural hedge and those proprietary risk models.
Yeah, and we analyzed the execution risks of shifting their development to AI agents and, of course, integrating those massive wealth management acquisitions. We also translated the accounting mechanics of their Q1 earnings to show exactly how macroeconomic forecasts dictate their current profitability.
It really serves as a masterclass in how a legacy institution leverages decades of structural advantages to basically buy the time and capital necessary to fundamentally modernize its technological core.
Could not have said it better. Thank you for joining us on this deep dive. But before we go, I want to leave you with a final concept to mull over as you go about your day.
Oh, let's hear it.
We are all deeply conditioned to think of a bank as a giant vault holding our money safely under lock and key. But when a single company employs 12,000 software engineers, when it relies on artificial intelligence to write nearly half of its foundational code, and when it uses autonomous software agents to spin up complex financial products in just 6 hours, at what point does it stop being a traditional bank and start being an artificial intelligence tech firm that simply happens to hold a banking license? Think about that.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.